Hi, my name is Layla and I'm the owner of Top Financial Agency. And in this video, I'm going to break down in an unbiased way the differences between the IUL, the GUL, whole life insurance. I'm going to talk a little bit about term and final expense as well. And I'm going to show you some illustrations of different carriers and show you some numbers and really explain to you with full transparency. And I'm also going to explain the biases that exist within the industry. And I'm even going to let you know my biases. Okay, so first off, let's talk about these biases. So you may have been doing some research online to try to learn a little bit about the differences between an IUL or whole life or term life. And you might see that some people love IULs or they hate IULs. Some people love whole life or they hate whole life. Some people only root for term and some people hate term insurance. So why are there so many biases? Well, number one, some agents are just not trained on all the different types of carriers out there because, well, some agents are captive. That means that they only work for a specific insurance company that sells only their type of insurance products. So, for example, Primerica is an insurance company and they sell only term insurance. So, if you were to talk to a Primerica agent, chances are that they have this philosophy, which is buy term and invest the difference. Now, they're going to talk negatively about whole life and IULs. And a big part of the reason is because they don't sell those products. So since they don't sell it, not only are they not fully educated on how the product works, but they're not going to encourage you to buy a product that they have no ability to sell. So think about it sort of like this. If you were to walk into a Nike store, you're probably going to be sold Nike shoes. Are they going to sell you Adidas? Probably not. But what if you walk into a Foot Locker? Then you can say, hey, this is a type of shoe that I'm looking for. These are my needs. And then they're going to walk you through different types of brands that are going to fit your needs. And maybe Nike isn't the best fit for you, but it doesn't mean that Nike is bad. So, other examples of captive agents include State Farm, Farmers, New York Life, Northwestern Mutual. So, they're generally going to sell term, whole life, universal life, or variable universal life insurance. They'll probably also sell long term care or disability insurance, but they're not going to sell IULs and they don't have living benefits. Now, although there are more than 400 other companies that sell IULs, and some of these companies have been around for over 100 or 150 years. So there's some companies that actually don't sell term insurance like Anico or Allianz. Now, Primerica has been around for 47 years and Anico has been around for 119 years. Allianz has been around for 134 years. And the last two companies don't sell term life insurance. So can we conclude then that since there's these companies that have been around for more than double as long as Primerica has been around, and they don't sell term insurance, then can we conclude that term insurance sucks? No, we can't conclude that. So we also can't expect that all insurance companies should sell the same types of products. That's why when you work with a broker who, and I'm using the word broker when I mean, let's say an FMO or you're working with an agent that's not captive, and they have access to all the different types of insurance carriers out there, you really have more options and you're usually going to get more of an unbiased opinion. So it's sort of like you walking into that Foot Locker and you can shop around with all the different types of insurance companies out there versus you walk into an insurance company, you walk into Primerica, you walk into New York Life, sells New York Life, or you walk into Northwestern Mutual, you're going to get the products that they sell you. So now I'm going to talk to you about living benefits versus long-term care. So Genworth is a long-term care company, and they said that in 2020, the median cost for a private room in a nursing home is over $105,000 per year. Now, Medicare doesn't cover all healthcare expenses, and Social Security might be depleted by 2037. Now, most people starting with Gen X and millennials and beyond don't have pensions anymore, and they sadly haven't really been saving enough for retirement. That means that in case of an unforeseen health emergency, they might not have enough money for their living expenses, and they're going to have to dip into their retirement or savings. So that's where living benefits comes in. Now, not all companies offer living benefits. They're going to offer long-term care, and these are the differences. New York Life, Northwestern Mutual offer long term care. Um, if you compare that to National Life Group, they're going to offer living benefits. Primerica offers terminal illness for 1 year. Companies like National Life Group offers terminal illness for 2 years, chronic illness, critical injury, and Alzheimer's, which is a new benefit that they offer that I haven't seen with many other insurance carriers. I haven't shopped all of them, but I know that that's a new benefit that National Life Group just added. So with long-term care, you have to qualify for the benefit. So let's say you have a chronic illness and now your long-term care benefit is going to kick in, but the caregiver has to specify every time that she visits you which two of the six activities of daily living that she helped you with in order for the insurance to pay out that benefit to you. With living benefits, as long as you qualify, you get the money to use however you want. With long-term care, if you don't use it, you lose it. So if you are paying for a rider that gives you long-term care, and if you happen to die in your sleep and you never get ill, well, all of those premiums that you've paid towards that long-term care are lost. With living benefits, since it's money that is it's basically you using the death benefit while you're alive. So if you die in your sleep, then the death benefit goes to your beneficiaries. But if you get a chronic critical terminal illness or Alzheimer's, for example, if you get it with National Life Group, then you have access to that death benefit while you're alive so that you don't have to dip into your retirement or your savings. And then once you pass away, then the rest of the money is going to go to your family. I've heard of people qualifying for living benefits and they take their money and they've gone to Mexico, for example, or even Germany, I've heard, to do alternative healing and they heal themselves. And the question pops up, well, what if I get ill and I use my money for my death benefit and then I live? Then great, congratulations. You don't have to give that money back. Now let's talk about financial advisors and their biases. Financial advisors also have biases just like life insurance agents. And I usually hear financial advisors suggesting very often term or whole life. And of course, they want you to invest in the stock market because they want to manage your portfolio. On average, financial advisors charge between 0.59% to 1.18% money under management fees. So that means whether or not you win or lose money, they are going to get paid for managing your portfolio. Whereas life insurance agents get paid from the insurance company a commission and also residuals, which are calculated in the cost of the policy. Also, if you were to roll over your 401k into an indexed annuity with a life insurance agent, they're not going to get paid from that amount of money. So if you have $100,000 in your 401k and you roll it over into an index annuity, you're still going to have that $100,000 in your index annuity. Life insurance agents are not going to get paid from that $100,000. Now, this is why also a lot of financial advisors might not want to sell index annuities because they don't get paid the same and as much really in the long term. If they're going to be managing your portfolio for the rest of your life, it doesn't really behoove them to sell a policy that they get a commission one time versus being able to manage your assets for the duration of your life. Now, also, they might use the argument that, well, you could make more money in the stock market with an indexed annuity. Yeah, and I'm going to talk about that. There's a lot of different ways that you could make money, but indexed annuities and life insurance products are going to offer different benefits. So I'm going to talk about that. Now, other times, financial advisors are either they're licensed themselves and they're appointed with a captive agency like New York Life or Northwestern Mutual, or they might be partnered up with a life insurance agent that works at a captive agency. So they're going to have the same biases as I mentioned before. Since they're limited on what they can sell, they're going to promote the products that they can sell and then find faults in the things that they can't sell. Now I'm going to talk to you about my biases because I have biases too. So this is a video about full transparency. So I'm going to let you know my biases as well. So I have my life, accident, and health insurance license. I don't have my securities licenses right now. That might change in the future. I don't really know. Personally, I'm not necessarily interested in carrying my securities license because once I'm securities licensed, that means that there's going to be limitations on how I'm able to market. Basically, I need to have everything approved by a compliance team, which I really have no desire for. I really enjoy my freedoms. Additionally, I really don't want to deal with the fluctuations of the stock market and how that's going to affect my clients. I even had a financial advisor joke with me, "Do you see all these gray hairs?" Yeah, it's because he's managing all these portfolios. People's money goes up and down, and it can be stressful, and I don't necessarily want to deal with all of that. So well, I know that investors that are investing in the stock market understand that the stock market ebbs and flows. I just don't want to have that burden on my shoulders. I don't want to have the burden of all these families out there and their money and their retirement on my shoulders. I'll leave that to the financial advisors. Now, also, there was a time called the lost decade from 2000 to 2009 when the S&P had a negative return. So, the only other decade in the United States to have a negative total return was during the Great Depression in the 1930s. And I see that we're moving towards a bear market and a recession is bound to happen. So I think that it's important to diversify our money. And I personally diversify my money, and I have the bulk of my money in guaranteed accounts. Now, I personally also like to diversify money in the different tax boxes. We've got tax now, tax later, and tax never. And life insurance, the IUL and whole life actually falls into the tax never category, as well as Roth IRAs, but Roth IRAs have limitations on contribution. So I personally have IULs. I also have term life insurance, and I have some money in stocks. I have money in crypto, and I'm a homeowner. So those are my where I personally invest. Like I said, I also have money in risky accounts, but the bulk of where I feel comfortable having my money is in guaranteed products. But on top of that, I have experience being a recipient of life insurance because my husband was the one who recruited me into the industry, and he trained me, and he passed away while our twins were 11 and a half months old. So I really understand the value of having life insurance. Life insurance is a check that you just get, and you don't have to pay taxes on it. I like that life insurance provided tax-free income to us. It can provide tax-free income to you while you're alive. So not just when somebody passes away, they give you a check, but in permanent life insurance, there's something that's building that's called cash value. And that's the money that you're able to use while you're alive in case of illness, emergency, retirement, vacations, and then also that tax-free legacy that gets passed down to your family. And of course, because of the living benefits, you can tap into that death benefit while you're ill, while you're alive, if you go with a company that has living benefits, and that money is also tax-free. So my bias is I believe that most everybody, if not everyone that can get approved for life insurance, should have some type of life insurance. Sometimes people will say, well, I'm going to buy a home, so I don't want to put money into life insurance. I'd rather buy a home first. I don't think that's very wise, and I'll tell you why. Imagine if my husband and I had just bought this brand new house together and he didn't have any life insurance and then he passed away. How am I going to continue to pay for the mortgage by myself? Am I going to lose the home? What if I was a single mom and he was a breadwinner? Or what if we had dual income? So I'm used to living and keeping a standard of life that includes two income, two incomes. Now, one of the income is gone and I'm here, a single mom with kids. So life insurance should be the foundation before all of your other investments. And besides, other investments, you might have to pay taxes on those. So, yeah, you can deduct it from whatever you have, but it's really nice to have money that you don't have to pay taxes on. Again, that's tax diversification strategy. And if that's important to you, then I think there's benefit into looking into how life insurance can help you with that. Now, life insurance isn't competing against the stock market. So when people say that investing in the stock market is going to get you higher gains, yes, that's true, but life insurance solves different things. There's plenty of other ways in this world that you can make higher gains, like real estate, crypto. You can get really lucky. You can get lucky in the stock market. You could also invest in other companies, for example, but you can also lose a lot of money too. Now, if that's perfectly okay with you, and if your um, level of comfort with, conservative, how conservative you are with your investments, if you're like, you know what, I'm not really conservative, I want all of my money in risky accounts, and that's perfectly fine. But the benefits of life insurance are these: tax free income, guarantees, income replacement, and legacy. I think it's one of the best ways to pass down tax free money to the next generation and to use tax free money while you're alive, which we already said is diversifying your tax consequences. Now, I have access to over 40 insurance companies. I can shop around to find the best product for your needs. We have IULs, we have term, we have whole life, we have universal life. I don't sell variable annuities. So if you want a variable annuity, you're going to have to go to another either agent that has the licenses to be able to sell it, because that's another bias that I have. I guess I don't sell variable annuities. Now, while variable annuities can also give you higher gains than an IUL and a whole life, for example, you also have the potential to lose money on top of you having to pay for the product. So now, if you received a quote for a life insurance company that is available only to captive agents, like if you have a quote from Northwestern Mutual or New York Life or Primerica, for example, and you want to compare what's out there, you can email me the illustration and we can compare. And if you have a really good policy, great, you have a great policy. Like, I'll be the first to tell you that you have a good policy. I'm not in the business of just converting or canceling people's policies to get them another policy just to give them a commission. I don't believe in that. So if you have an awesome product, I will let you know that you have an awesome product. And if you're just curious, if you're like, hey, let me just see what other products they're out there, I have no problem showing you some illustrations. So now I'm going to break down the different types of coverages, and I'm actually going to show you some illustrations. So first, term is the most affordable insurance. Think about term like this. Term is temporary unless you convert it to a permanent life insurance product, which is only available with carriers that offer both term and permanent. So Primerica, for example, is an insurance company that only offers term insurance. They don't offer permanent insurance, so all of their term products are going to expire. Now, you may want to also take a look at the carrier's options for permanent life insurance if you're intending to convert your term to a permanent, so that you know what your options are when converting. And also pay attention to the living benefits if that's something that's important to you, because different term products offer different types of living benefits as well. So let me show you some quotes. Now, here in this example, I did male, age 40, and actually you're going to see their standard plus and then just regular standard, because some carriers will have it written as standard plus non-tobacco, some will just have it as standard. So I'm just going to run through some of these numbers. So Columbus is 73.95 a month. Corbridge, formerly known as AIG, is $81. Banner, Pac Life, Transamerica, Nationwide, Prudential, You can see some of the prices here in North American. North American has a little bit more living benefits than Corebridge, unless you get the Corebridge QOL. $1 million. It starts at one of the cheapest products that you can get at a standard rating is $135. Select a term QOL is going to have more living benefits here than the select a term. This one doesn't have any living benefits. But these both also have permanent products. So this shows you, basically different types of carriers that you can shop for. Now let's get into guaranteed life insurance like the GUL, which is guaranteed universal life. Sometimes it's ran as just a universal life. And it's cheaper than final expense, and final expense insurance we'll get into right now as well. You can get approved without medical for somebody who's healthy. You pay the premium, you get the death benefit, and it's guaranteed for life. And the goal is to pay the lowest premium to guarantee the maximum death benefit for life. Cash value isn't building in the same way as it is with an IUL, for example. And although you can take loans against the policy when the net cash surrender value is available. And let me show you now an example of a UL from Pac Life. This is an example of a 45-year-old male, and he is paying $5,000 annually, and he's getting $500,000 worth of coverage. So the purpose of this policy is the guarantee. So he's guaranteed a death benefit, but he also has the enhanced surrender value, which is available for a 60-day period following the quoted policy anniversaries. So he'll hit his first surrender value in 15 years at $56,000, and at 20 years, $100,000. So he's able to say, hey, I don't want this policy anymore. After 15 years, he'll get $56,000 in return. And the death benefit is guaranteed. That's the purpose of this policy. It's not for somebody that's really looking to gain cash value. It's really for somebody that just wants a guarantee that they're going to get life insurance for the rest of their lives. That's the purpose of this product. So it's a pretty simple illustration. Now, final expense. So the purpose for final expense insurance is just to cover the cost of the funeral. This is for somebody who's a senior and they need burial insurance. Maybe they haven't purchased any other type of insurance and now they need something for funeral costs. I would say it's probably the most expensive, and coverage is usually small. It's about 25,000 or 30,000. Some carriers might give you up to 50,000. But this is also good for people that have health issues because you can generally get coverage even though health isn't the greatest. Although you can get rated either level or graded, meaning that depending on the rating that you get, if you pass away within the first 2 years, the insurance company is going to pay your family your premiums back plus a percentage of the death benefit, maybe let's say like 10%. But if you pass away beyond the 2 years, then your family is going to get the entire death benefit. But that's if you get a specific rating. That's going to be somebody that's probably pretty sick and maybe the mortality looks like they're going to pass away within the first 2 years. Now, there's probably going to be some variances depending on the different type of carrier, but that is a final expense. Now I'm going to go into the IUL. Now, the IUL stands for Index Universal Life Insurance, and it has flexibility in premiums and also flexibility in the death benefit. If you want to maximize the cash accumulation, then you are going to want to minimize the death benefit. Cash accumulation is based on index credit, and the more premium you put in, the more potential for cash accumulation. I'm going to show you a few examples of that. When you pay your premium, dollars are going not only towards the cost of insurance, but also cash value rather than the guarantees of the policy like a whole life. The fees are also front loaded with an IUL, so you're going to see heavier fees in the first 10 years of the policy, whereas a whole life policy has fees spread out through the life of the policy. Now, there's more potential for growth in cash value of an IUL versus whole life, which is going to be a little bit more rigid, but you can stop paying premiums earlier with an IUL because it's growing cash value at a higher rate. And you can also choose when you want to stop paying the IUL, like let's say 25 years or sooner, but just keep in mind that the premium is going to be a lot higher if you really want to stop paying that premium a lot sooner. There's also different ways that you can pay off the IUL. You can do like a 7-year pay. You can do a big lump sum. So you have a lot more flexibility in how you want to pay that IUL. Now, while the cost of insurance continues, even though you've stopped paying into your premium, the cash value is continuing to compound and grow. So you're still going to be outpacing the cost of insurance. And I'm going to show you some illustrations that includes policy charges. I'm going to show you that right now. This is an example of an illustration by National Life Group. Now, this is funded at Target. I don't sell them funded at Target. I usually will overfund the Target, but I created this illustration just to show you what it'll look like if you stop making payments at 65, and also to show you the policy charges page. So this isn't how I would normally structure it. It's just to show you the other 2 points that I really want to emphasize. But here it's $500 a month. This is a 30-year-old male. He'll get $741,000 of death benefit. And if he needs cash, and like it says right here, I can take a loan or withdraw from my policy's cash value, potentially tax-free, which if you take it out as a loan, it is tax-free. And if he's 69 years old, there's $758,000 of income available to him. At age 74, he'll have a little over 1 million. At 79, 1.4 million. And at 84, 2 million. Now, if he becomes ill, National Life Group, I would say, has one of the best when it comes to living benefits, especially because they also added Alzheimer's disease benefit. I don't know of other carriers that do, but in all transparency, I haven't shopped all the carriers out there to know if they do offer Alzheimer's disease benefit. It's possible that others do as well. But if he gets terminal illness, he'll have $664,000 lump sum, $12,000 per month in case of chronic illness. And this will pay out to about 50 months. Critical illness, critical injury, these are heart attack, cancer, stroke, paralysis, etc. And then Alzheimer's disease. Everything is lump sum except for the chronic illness. And here you can see the ratings. This page will show you the hypothetical returns by strategy. So you can choose different indexes and you can change these annually. So you've got the US Paysetter point to point. Some of these have no cap, like this one is a no cap index. The balance trend also is no cap. The S&P 500 does have a cap, so this one is 9.25%. Now, if you take a look at the 5-year average, this is how they perform. And 10-year average, 15 and 20-year average, but it's going to illustrate it at 6.44% or 6%, 4%, 5, depending on the index. This one is structured with the US Paysetter, so it's going to illustrate it at 6.44%. Here we also see index crediting method. So the S&P point-to-point cap focus is 9.25%, meaning that whatever the stock market does, the most that you can get is a 9.25% with a guaranteed cap rate of 3%. Current participation is 105%. So whatever the market does, you multiply that by 105%, but you're guaranteed to get 100% of the participation up to 9.25%. US Paysetter does not have a cap and it has 235% participation. And if you look up this index, you can see how it's performing. This illustration is going to use 100% in here. So you're going to see the illustration at 6.44. You see right here. So it's going to illustrate it at 6.44% when we get to the ledger. Now that we're at the ledger, I'm just showing you that this one is level. Again, I am not overfunding. This is not overfunding the target. The purpose of this was really to come and show you the policies and the fees, but you can see it's structured at 6.44%. I also made the death benefit level. You do have flexibility with the IUL, so you could make it level or increasing, and it will change. The cost will either have to put more premium into it if you want it to be increasing, or drop the death benefit if you're trying to stay within a budget. But you do have flexibility with the death benefit and also the premium. Now, the fun part, we are going to take a look at policy charges. Now, if he is funding it at $500 a month, that's $6,000 annually. And you see there's a premium expense charge, the cost of insurance, policy fee, expense charge, accumulated value charge. So the total policy charges for the first year is $2,184. They will credit $132. So this becomes the accumulated value. But remember that in IUL, the fees are front loaded. So they're going to be fee heavy for the first 10 years, which is why you've got the surrender charge. And again, this is not funded in a way to have cash value immediately. I have different illustrations to show you on that. Okay. I just want to show you how the charges work on an IUL. And then after the first 10 years, the surrender charge is the last year for a surrender charge, and there's no surrender charges moving forward. So compare this to a whole life, which we'll talk about next. Their fees are level and a little more expensive towards the end, whereas the IUL is heavier in the beginning. Now, this one is structured to have him stop making payments at the age of 65. So 65 years old, that year he'll make his last payment. So then, of course, there's no more premium charges here. There still is a cost of insurance and there's policy fees. So there's still a policy charge. But if you take a look here, let's just say policy year 40, in total, he would have paid into his policy $216,000. The total policy charges have been $80,000. He has been credited $622,000. So he paid $216,000 to get credited $622,000. And then he also has a death benefit of $880,000. Remember, chronic, critical, terminal illness, or Alzheimer's, he has access to this $880,000. And this $758,000 he can access income tax-free for vacation, retirement, emergency, for his kids, you name it. At 74 years old, he'll cross over $1 million of potentially income tax-free. Okay, I am going to show you 3 more IULs. This one again is with National Life Group. I am not a paid sponsor with the National Life Group. I can show you an Allianz illustration. There's Allianz right there. Okay, so I can show you different ones. I am just going to show you this. So this is what I want to show you. There's flexibility in how you can structure an IUL. And there's a lot of flexibility here with National Life Group. The reason that I'm showing you 2 illustrations is because of this. This is a whole life policy, which I'm going to go into depth about in just a little bit. But this illustration is a male, 45 years old, non-tobacco, $500,000 of death benefit for $952 a month. For $500,000 for a male that's the same age, he can start off with $400 a month. Now, this is not structured for him to maximize his cash value. This is still overfunded, but the purpose of this illustration isn't for him to try to really accumulate a lot of cash value. So I'm going to show you this one. This one is $500,000 for $750. So let's just take a look at the difference in cash value. So if we're going to look at here, $400 for $500,000, this is a summary, so it'll just be easier to show. At 69 years old, there's $158,000. At 69, there's $375,000. At 74, there's over $500,000 that he reaches. There's $200,000 at age 74. At age 79, he has 283,000, 84, 368. But if he's paying $750 a month, then he's got 837,000 and 1.2 million at the age of 84. Now, the living benefits don't really change very much. You see here 432,000 at $750 a month versus 421,000, and then there's 7,000 a month there, still 7,000 a month there. So this doesn't change a whole lot. But what I wanted to show you was that you can get something and really overfund it, or get it and not really overfund it. It just depends on what your goals are. Allianz is about $13,000 annually for $500,000. Oh, another point. You see, this one is increasing. You see how the death benefit is increasing. This is how we structure an increasing death benefit. Over here, so this one's at $500,000. It's level. So that means the death benefit doesn't increase until 72 years old. This will allow some more cash value to grow into the policy. This one at 400, I also made it level. If you make this one increasing, then the premium is going to have to be higher, or you can blend it. And that's just getting a little bit more technical. That's not necessarily for this video, but just know that you could make this death benefit increase, or the death benefit is going to continue to grow. It will cost you more money, or you have to reduce the death benefit to start, but you've got a lot of flexibility with premium and death benefit when it comes to an IUL. Last point that I want to make that I know people are going to question is, what happens to my cash value? Well, without getting too much into the weeds, the death benefit is what's going to pay out. So whatever you see here is what's going to pay out after you pass away. So until the cash value starts growing, and then the death benefit starts to grow. Internally, what's happening inside of the policy is that the cash value is going in there, but the death benefit is being reduced in order to keep the death benefit level so that it makes it more affordable this way. You can structure it so that this is increasing, similar to the Whole Life, and also similar to that Allianz, which was an increasing death benefit. So you can do that as well. Just realize that if you make this increasing, then let's say, the third year, your death benefit increased, like right here in the Whole Life policy, year 3 death benefit increased to 511,000 in this scenario. So here the death benefit would increase, and that's what you're going to get, but it's going to be a more expensive policy, which means that it's not going to cost you $750. It'll probably cost you $850, or maybe even $900, depending on how this is structured. Now, we could get this death benefit and blend it, which is getting even more technical, and that's probably going to have to be for another video. But really, it's figuring out what is your need. What are you looking for? Do you want a guarantee? Then a Whole Life is great for you. If you want to make, and of course it's going to cost a little bit more because you're paying for that guarantee. Do you want to make sure that you have a dividend every single year? Great, then a Whole Life policy will work for you. If you want a little bit more flexibility, if you want it to mirror the index because you are banking on more growth long term, or I should say on average overall, then an IUL will be there for you. And if you want more living benefits, and I think living benefits are important because people tend to get sick the older they are. And if you get a policy that doesn't have as many living benefits, then you're going to have to be tapping into your retirement or your savings, which is another reason why I like carriers that have living benefits that can last you for the rest of your life. Now, depending on the index that you select for your IUL, you can return a 0% gain for that year. And if you're still paying your premiums at that time, the premium will go into the cost of insurance. But if you have an outstanding loan against your policy, then you might notice a decrease in the cash value. So that's getting a little bit more technical, but it also depends on how big the loan is and how much cash value you have in there. There's a lot of different variables that can show you that. Now, you can loan against your policy in different ways. Like there's something called a wash loan or a participating loan. to give you just a couple ideas. A wash loan would allow you to get that loan at zero net cost. In a participating loan, you might be able to even get a gain on your cash value while you have that outstanding loan. So let's say that your loan interest rate is about 4% and your IUL returns 5%. Not only did that loan not cost you anything, but you also got a gain of 1%. Now, whole life policies have fewer options when taking out loans, and a GUL even fewer. Now, there's a strategy called Kaizen, which I've done a video on, and it's a strategy where a lender funds your IUL for 10 years while you fund it for the first 5 years. And after the terms of that agreement, the lender is going to get their money back from the cash value, and you're going to keep the remaining cash value and the death benefit. So this allows you to grow your cash value using leverage to create for yourself tax-free income. Now I'm going to go into a whole life product and show you some more illustrations. Now, if you are looking for a guaranteed death benefit, then whole life is also an option for you. And I say also because the GUL is guaranteed death benefit. So whole life is a guaranteed death benefit as well. Now, the money isn't growing. Your cash value isn't growing like an IUL because it is not tied to the stock market, because instead you're receiving dividends. So the potential for cash value growth will be less than with an IUL, because if we're looking at averages, the S&P 500, for example, if that's the index that you chose for your IUL, it typically is going to have higher gains overall on average than dividends. And I'm going to show you comparison of different whole life carriers and how dividends have done historically. Since a whole life policy is guaranteeing your death benefit and they're giving you dividends annually, it's going to be more expensive. So get ready to see those comparisons. A whole life policy is going to be more of a slow and steady growth compared to an IUL. And some people might like that. Some people might want the guarantee of the death benefit and they want to know they're going to get those dividends every single year. Maybe they don't want to risk having a 0% back from an IUL 1 year, even though you can change the index so that you can put it into a fixed account, but the fixed index is still going to be probably less than a dividend. But if you're looking at averages and overall, the IUL I think will perform better, and I'm going to show you that. But again, it's not to say that the IUL is better than the whole life or the whole life is better than the IUL. They're just solving for two different things. And just like we don't all wear the same types of clothes, we don't wear the same types of shoes, there's different things that we want in our financial products. So yeah, I'm just, that's what I'm explaining to you how all of them work. Now, since cash value is based on dividends, which is determined by the insurance carrier, meaning that at one time, that insurance carrier in 1 year could have given dividends back at 12% or 8%, but maybe right now they're at 5% or even below 5%, and they actually have the choice to drop or increase. But while whole life companies have historically not missed paying out a dividend, their averages still do not beat the S&P average in an IUL. So while some financial advisors might give the objection that a whole life policy will give you a yearly dividend while an IUL can return zero, that can be true, but with an IUL, you can change the strategy so that you have some or all of your money in a fixed account, which, like I said, it still can be lower than the dividend gain. But when you look at the averages, the IUL is still going to outperform the whole life. Okay. Again, different products have different strengths. Now, Mass Mutual is great for guarantees. If that's what, that's just an example. By the way, there's all different types of whole life carriers out there, but Mass Mutual, for example, is great for guarantees. If that's what your main goal is, Lafayette has more flexible product options that includes a focus on accumulation, short pay design, or early cash value. So let me show you now a snapshot of the comparison of the historical rates of the dividends from the different whole life carriers. Here is an example of different whole life carriers and the dividends dating back from 2014 to 2023. You can see all of the different companies listed to the left and the different dividends that they paid out. So the key word with whole life is guaranteed. But with any guarantee, it's going to come with a higher cost, which doesn't make the cash accumulation as aggressive as an IUL. And also, when it comes to paying your whole life policy off sooner, you do have the option for that. Whole life usually has pay to 100 or pay off in 10 years, but it's going to be obviously more expensive. Now, you can pay off a whole life in 25 years, and you can do that by applying the dividends to reduce the premiums, unless a carrier, for example, has premiums are already built in so that you can pay it off within 25 years. So there's different ways that you get your dividends. You either get them as cash, or you get them to guarantee your death benefit, or to reduce the premiums. So those are some things that you want to look at when you're getting those dividends back. Now, a whole life death benefit can be more rigid than an IUL, which can be structured with an increasing or level death benefit. So this is Mass Mutual, and this is a 45-year-old male, non-tobacco, $500,000 for $952 a month. So if you take a look here, so whole life is guarantee. So that's the purpose of this. Also, it's guarantee. And the cash value that's growing is based on dividends. So after 5 years, at the end of year 50, there's about $28,000 accumulated. After 10 years, there's $86,000 accumulated. If we jump to 20 years, there's $266,000 accumulated. Now, if you compare long-term a whole life policy to an IUL. So let's say this one, which is $500,000 for only $750 a month. Let's just compare these numbers. And now again, I'm not trying to compare that the IUL is better than the whole life. We're just looking at two different products that serve two different purposes. And the whole life is for guarantee, and it's going to pay you a dividend every year. The IUL, you might get a 0 year, unless you put some of your money in an index that's going to guarantee a fixed rate. So they work a little bit differently, but still just to sort of see. And this one, I did not make it increasing. So this is level, which allows more of the cash value to go in here. So if you take a look at the whole life policy at the end of year 50, there's $28,000 in there. Here at the end of year 50, there's $35,000 in here. If at the end of year 10, there's $86,000 with the whole life. And at the end of 55 years old, because the other one was 55 years old, there's $90,000 in there. Here, I mean, it's sort of, I hope it's not confusing to you, because even though it says year one, but it says age and year. So they kind of have it a little differently. So we're just going to look at the age. So at the end of age 65, there's $266,000. And here at the end of year 65, there's $268,000. So it's sort of close, right? But then remember, this one's only $750 a month. This one is $952 a month. So I'm not trying to compare. I'm not trying to say that the IUL is better. We're just looking at numbers overall. Remember, you could get a 0 here unless you switch the index. With a whole life policy, you're generally going to get the dividends every year. So I hope that you were able to get some good information. Now, I do have a video where I go into depth about how to illustrate an IUL with NLG. In this video, I showed you some variations of IULs along with some fees. Now, I couldn't really show you the fees with the whole life policies because they don't seem to illustrate them. I also have an illustration from Northwestern Mutual, and I was able to compare Northwestern Mutual with some of the other whole life products. The reason that I didn't show it in this video is because I personally don't sell it, so I just didn't want to show it. Although you can reach out to someone from Northwestern Mutual and then come over here, and then we can compare some of those numbers. Now, if you have a policy, or if you just received a quote from any other insurance company, we can always compare to see if there's any other options, especially if you got a quote from an agent that's with a company that's captive or with a company that's limited on the types of insurance products that they can sell. But if you do have a good policy, then I'll be the first person to let you know. I'm not going to just try to say, no, that policy sucks and let's cancel it and get something else. And at the end of the day, you're the one that's making that decision. You can email me your policy and I can email you another illustration, and you're reading it, you're comparing everything, and you're deciding what's important to you. So I'm not the one that's going to let you know that your product is good or not good. The numbers are there, everything's there. We're going to be able to look at everything from top to bottom. So if you want to reach out to me, head over to topfinancialagency.com. And if you hover over the homepage, you're going to click the little button that says get a quote and submit your request. So I hope you have a good day, and I hope this was valuable. Thank you.